What data do you need to look at in your agency to optimize profitability? In this episode, we examine the relationship between operations and finance in an agency and examine metrics that matter for profitability. You don't need to be a CFO or COO to benefit from this episode. You just need to be curious about what metrics to track. You'll gain a fundamental understanding in this episode of what might be missing in your profit and loss statements, the importance of the delivery margin metric to your profits, why time tracking, even if you don't bill by the hour, is smart business, and the one thing people get wrong about utilization rates. By the end of this episode, you'll be able to identify areas for improvement to boost your profitability. Tune in. Welcome to the Small But Mighty Agency Podcast. If you're a marketer, a consultant, or a creative who's on the journey of growing from solopreneur to agency owner, follow along because I pull back the curtains on the realities of growing and running a scalable service-based business and building a lean team. I'm your host, Audrey Joy Kwan. I know what it takes to build an agency. Whether it's from solo to 3, 5, or 20, I've done it, including supporting an agency owner to sell and exit. I've coached and consulted over 120 marketers, creatives, and consultants, and I've been behind the scenes of 7-figure businesses. I also have a master's degree in communications, specializing in organizational development. All this to say, I know what it takes to grow, lead, and operate a multiple 6- and 7-figure small but mighty agency. And here on this podcast is where we'll dive right in. Hey friends, it's been a while since we've had a guest on the show. I'm excited to begin our conversation with Marcel Petitpas. Marcel is the CEO of Parakeeto, a company that helps agencies track the right metrics and improve profitability by leveraging their technology. Now, who doesn't like a conversation about profitability, right? Marcel, welcome, and tell us a little bit more about yourself.
Thank you, Audrey, for having me. I'm excited to be here. As you mentioned, my name's Marcel. I'm the CEO of a company called Parakeeto, and I help digital and creative agencies measure and improve their profitability. And our firm does that by helping agencies install a framework for measuring the most important KPIs in their business, and in particular, doing that in a way that gets all of the stakeholders on the team aligned around one way of looking at the business that really connects the dots between finance, sales and marketing, and the day-to-day operations of the firm. So everyone's on the same page about how the things that they do contribute to the overall success of the business.
Before we dig into your framework, tell me more about you. I know your agency experience inspired your current business. Give me the details of how you got started and the inspiration behind launching Parakeeto, which is your software company to serve agency owners.
Yeah, so my first business was an agency, so I know what it means to be in the trenches running a service-based business. And then, of course, Parakeeto is also a primarily service-based business today. And I first got familiar with this problem space when I was trying to answer those questions that we ask ourselves every day running a small agency. Things like, are we making money on clients and projects, and which ones are making more or less money? Are we utilizing our team properly? Who and when might I need to hire? And how does that change as we do or don't get new clients in the door? And really trying to piece all of these things together, I found challenging. I found it time consuming. And so I had been familiar with that experience when I ran that agency. I then kind of transitioned more into starting software companies. And I got a call one day from a friend of mine who ran a big software development firm. And he said, hey, my team, at my software development agency spends a couple days a week in spreadsheets trying to answer these questions. And there just has to be a better way to do this. And immediately I resonated. And that's really what kind of got me into focusing on this problem space and taking more of a technology and consulting approach to solving that problem.
Okay, nose deep in spreadsheets a couple of days a week is no fun, at least not for me. I'm sure any visionary entrepreneur will agree. And what you've identified is that there is a better way than using spreadsheets to answer pressing questions. So what are some of those common questions that owners get buried in spreadsheets with?
Yeah. So to me, the biggest problem is that most of them can see when they look at, for example, a financial statement that they get from their accountants, that they're not as profitable as they want to be. They see money coming in the top and they see very little of it coming out the bottom. But often what's unclear to them is why. And in some cases, they're measuring a lot of tangential KPIs. So they're paying attention to things like, revenue per full-time employee. They might be trying to measure things like utilization rates. They're trying to discern project profitability. They're trying to do resource and capacity planning. And I've heard in a lot of cases this just doesn't seem to make sense. Like when I look at all of these KPIs, it seems like we're doing well, and yet my EBITDA is still 10 or 15 or 20% lower than I think it should be. And I just can't quite put my finger on why that is. And so I think the big challenge really is coming up with a framework that clearly connects the dots between the financial outcome of the business, the decisions that get made about people, time, and projects on a day-to-day basis, and then sales and pricing and scoping and how that ties in. And the real challenge is connecting the dots in such a way that if you make a change to any of those three areas, you know exactly how it will impact everything else. That level of consistency is very elusive to most firm owners because the way they build their KPIs and their understanding of the business is by grabbing the definition of one metric from over here and grabbing their financial targets from over there. And those measurement standards are not designed to relate to one another. And so they often end up with these gaps that result in a delta on their bottom line that is just hard to pinpoint because it's very nuanced.
Marcel, we've got a lot to unpack there. Okay, so a core challenge is that the business is bleeding money somewhere, but they don't know, or you don't know really where the leak is.
Yeah.
What do you suggest is the next best step?
Yeah. So I'll zoom out because I think the place that a lot of people want to go with this conversation is like, what tools should I be using and what metrics should I be tracking?
Right.
And of course, those are important questions, but they're not actually the most important questions. And a lot of energy can be lost trying to focus on those things, which is like the trees rather than the forest. So to zoom out, I think the first thing that we have to understand is what is the financial model of a professional services firm? And let's start there. And I think the biggest issue that I see starts with how most finance consultants set up the profit and loss statement for an agency, which doesn't allow them to differentiate between what it costs them to run their business and what it costs them to earn their revenue. And what I mean by that is when you look at most profit and loss statements for agencies, what you'll find is that there's income, and then usually in cost of goods sold, there's things like pass-through expenses that are being isolated. So, for example, a media agency, their media spend might get captured at a cost as a cost of goods sold, or perhaps a web development agency that hires an external vendor to do the development. That external vendor cost might go in cost of goods sold. Or if you did a lot of print or out of home for clients, you might capture those as a cost of goods sold. So when they look at their gross profit line, a lot of times they have this false positive, which is like, oh, look, our gross profit's really good, because those are our costs of goods sold. But of course, those aren't that agency's cost of goods sold. That's revenue that never belonged to them in the first place. It's money that's passing through them onto other vendors. They're not responsible for the profitability of that money. It doesn't actually influence their economic model at all. And what's not being measured now is, okay, well, the money that's left over that you're now responsible for earning with your team's time, what is it costing you to earn that money? And how much of it is left over once you've delivered on all the promises? And the reason that that's typically not visible is because all of the payroll for the company, all of the software expenses are lumped into one big account and called OpEx, or called overhead, right? And so there's this black box, and it's framed as OpEx and it's framed as overhead. And so as an owner, your visceral reaction to that is, oh, I have an overhead problem. And so you start to focus on things that seem like overhead. I'm going to try to find the $50 version of this software that I pay $100 a month for. I'm going to try to get my bookkeeping costs down from, $500 a month to $300 a month. And there's just not that much juice in that squeeze. And the fundamental problem 9 out of 10 times is you're just spending too much money to get the projects done in the first place, either because you're undercharging or because you're over-servicing or because your utilization isn't optimized. There's a bunch of reasons why that might be. But when we solve that problem, overhead's not an issue anymore. But the lack of differentiation between those two problems on the P&L is the first and most fundamental problem that I see. And then there's all kinds of other things that stem off of that.
Okay, so a core challenge can be financial consultants setting up profit and loss statements without a crucial understanding of an agency's realities. As a result, skewed data leads to decisions that don't really make an impact.
Yes.
So business owners end up wasting time focusing on small things like reevaluating their software stack and trying to squeeze that down. And the impact there is minimal. Returning to your analogy of the forest and the trees, the software stack is the tree. Okay, so tell us more about the forest. What do we need to know so that we're paying attention to the forest instead of the trees?
Yeah. So really, there's one really important thing, which is what I call delivery margin. So delivery margin to me is after you've stripped out pass-through expenses and you've arrived at what I call agency gross income, but that's really the revenue that's left over for your agency to earn. What is it costing you to earn that revenue? And the margin on that is what I call delivery margin. And so really what most agencies are failing to do is they're failing to properly isolate their pass-through expenses. And then they're failing to isolate their what we call delivery costs. So the amount of payroll, the software expenses, et cetera, that are required for doing client work, which then allows them to understand what their delivery margin is on their work. And the objective is to get their delivery margin to 50% or more. And I think the next conversation is, well, how do you do that? There are 3 ways to improve that delivery margin. And those are operational metrics that can be measured on a day-to-day basis without having to rely on financials. So we can get into that. But the starting point really is that most firms don't know their delivery margin. And most firms that are suffering from profitability issues are having that experience because their delivery margin isn't healthy, but they can't even see that. They can't even identify that as an issue because of the way their financials are structured.
Now that we've identified that delivery margin is the challenge, what symptoms demonstrate to an agency owner that they don't have a healthy delivery margin?
Yeah. Well, the first would be that the more you sell and the more you grow, your profitability does not improve, or worse yet, it gets worse. And often we see that as being an issue. And I've had this conversation many times before of a founder saying, my agency is bigger than it used to be, and yet somehow I'm personally making less money. You are busy and your team, is busy and you're bringing in lots of work, and yet it feels like there's never any cash in the business, and you're struggling to make payroll, and you feel like you're hand to mouth, despite the fact that there's tons of money actually moving through the enterprise. You might find that you're being really, really lean and really diligent about overhead spending, and yet you're still not that profitable despite not having an office and really being diligent about that overhead spending, and even maybe paying yourself a very small salary as a founder. So if those have been your experience, and the one that I hear the most often is your accountant is telling you you're overstaffed and your team is telling you they're overworked, and you're not sure who to believe. If that's been your experience in your business, then that is clearly a delivery margin problem from my perspective.
Awesome, Marcel. Those are some very tangible challenges an agency owner wondering if they've optimized the profit and loss statement for agency realities can relate to, or hopefully not relate to, because ultimately we want healthy delivery margins. But if any of those challenges sound like you, lean in and let's talk about improving them. Marcel, give us your thoughts on optimizing delivery margins.
So to set this up, the formula for delivery margin is your agency gross income. So that's revenue minus pass-through, minus your delivery cost divided by agency gross income. So for example, if you made $1 million in agency gross income and you spent $400,000 on payroll and software subscriptions for your delivery team, then you would have a 60% delivery margin. So at the surface level, you can see that there's really 2 levers to improve that. You can either increase the amount of revenue that your team makes without increasing their cost, or you can decrease the cost of your team while not decreasing the amount of revenue that they earn. That sounds easy enough. But in practice, the proxies for that are 3 numbers. The first that we're going to focus on is a proxy for delivery cost. And that operational proxy is what we call average cost per hour. So average cost per hour really measures for any area of the business, on average, what is it costing us to do work? And so we calculate this by looking at payroll divided by capacity. And again, this is a metric that, and all of these metrics, all 3 of these, by the way, the reason I love them so much is they can look at any subsection of the business. So you can look at any time period, whether it's a day, a month, a quarter, or a year. And you can look at any horizontal plane of the business. So you could look at a single project, a client, a group of clients, a department, right? Whatever cross section you want, as long as you can aggregate what was the total payroll across that segment and what was the total capacity. And that starts to give you a sense of, on average, what does an hour of labor cost us in that area of the business? And this is a useful insight because you could start to identify when we do these kind of highly strategic projects, it requires a lot more expensive labor to do that work versus this other service offering where we can use a lot less expensive labor to do that work. And it might start to surface areas of the business where stuff that you're really an expert in, Audrey, can be very helpful, which is how do we decrease the level of judgment that's required to do this work, which should allow us to hire less experienced people to do that work, which generally correlates to a lower cost for that staff. And so if you can start to displace stuff that a really senior person needs to do today and get them onto a more junior person, in aggregate, you can start to lower your delivery cost without actually changing the amount of revenue that your business can earn. So that's kind of the first lever to pay attention to, is where are you having to leverage really expensive talent to accomplish deliverables for the client.
Let's explore the concept of hiring more junior people to fill senior roles. Now, senior talent in a business obviously has different roles and responsibilities than a junior team member. For example, a senior function in an agency might have someone with a strategic mind and lots of niche experience. And this person would be difficult to replace with a junior because of the skills, knowledge, and expertise. So it's less about replacing senior talent and more about ensuring you're not too heavy on senior staff.
Yeah.
And we do that by ensuring that leadership is well developed and processes and SOPs are in play. Marcel, maybe you have an example.
I do. We'll use an example from my business. So the first thing that we do with any of our new clients is called an agency audit. So when we first started doing that service offering, we didn't have much process. We didn't have many SOPs. We didn't have a lot of technology built to facilitate the process. And so there was a lot of uncertainty. And therefore, it required a lot of judgment to go from the beginning to the end of that deliverable and get a successful outcome for the client. And so a consultant, which, in our business costs about $160,000 a year to employ, had to spend about 40 hours on that deliverable. And as we built better SOPs and better processes, what we realized was a lot of that consultant's time was spent doing things that really they didn't need to be doing. It was collecting information from the client, setting up a spreadsheet environment, building out a template for a deck, doing data analysis, stuff that a data analyst can do. And when we started to look at who else could do those roles, we realized, an account manager or a data analyst could do a lot of this work. And so we were able to displace about 70% of the time required to get an audit from the consultant onto people that cost half or less than half of what they cost. And so effectively, we dropped the average cost per hour on that deliverable down by about 50%, which immediately improved the margin. And what that means is, as we do more and more of these audits and we have to hire a larger and larger team, rather than having to hire people that cost $160,000 every time we need to increase our capacity, we can hire people that cost a lot less, but still grow the revenue at the same rate. So that would be a practical example of, on one of our deliverables, how we used process improvement and documentation and technology to displace expensive time and replace it with lower cost labor.
100%. This really speaks to structure and the power of processes in agencies. Structure means more clarity in roles and responsibilities, but as agencies grow, sometimes roles must be clarified better. Optimizing your processes gives you that clarity and saves you time and money. Processes can clarify whether a senior team member's time is being spent in the right place or whether a junior team member can support those tasks to free up their time, impacting the agency owner's bottom line. And speaking about the bottom line, you mentioned 2 additional levers to look for in profitability. Let's get back into it.
The first one is what we call average billable rate. Now, there are some people that are listening to this, they heard the word billable rate, and immediately they thought, I don't bill by the hour, so this is not relevant to me. And you would be wrong, dead wrong about that. Average billable rate, what I love so much about this metric is, again, it is scalable both horizontally and vertically. So you can look at any time period in the business, and you can look at any cross-section of work, and you can also normalize every single billing model that there is. And we see this in lots of firms. Some projects are time materials, some of them are a flat rate, sometimes we value price, sometimes it's a little bit of both, sometimes it's a retainer, sometimes it's a project. So there's a lot of complexity in small firms these days when it relates to billing models. Average billable rate allows you to compare all of them apples to apples, because the formula for average billable rate is agency gross income, which I'll just remind everyone from earlier is revenue minus pass-through, divided by what we call a delivery hour, or the number of delivery hours worked on that agency gross income. So you notice here that it doesn't matter how we build the client. What we care about is what amount of money was collected and how much was left over after we removed our pass-through. And then we use the word delivery hour, not billable hour, because then the question is, how many hours did we invest to complete those deliverables, regardless of how that impacted the scope or the price of the project? We don't care. How much time do we spend to get it done? So that starts to allow us to get a sense of what is the efficiency of different time periods or cross sections of work in the business, and identify, hey, when we do website projects, on average over the last 6 months, we've earned $120 for every hour that we spent on those kinds of projects. But when we did SEO work, we earn $250 for every hour that we invested. That's interesting. And we can start to ask really good questions of the team, like what's going on in SEO that is allowing us to be so efficient? Is there something we can learn there and apply to other areas of the business? Or what is it about websites that are causing us to be less efficient than we expected? Are we missing something in scoping? Is there something about the clients we're bringing in that's causing friction? Is there something about our process that maybe we want to take a closer look at? And it seems too simple to be true, but if you think about it, if you could sell every hour that your team has available for twice as much money, your business would do twice as much revenue. It sounds like that's too simple to be true, but it really is. So that's the power of focusing in on average billable rate and starting to see the insight that it can give you into where in the business you're able to generate more efficient revenue for your team.
Yes, if you're raising your hand and saying, we don't bill by the hour, this doesn't apply to me, I think Marcel's getting down to this. Even if you don't bill by the hour as an agency owner, knowing how many hours it takes to deliver work helps you make better decisions. If you don't know the numbers, you're at a disadvantage because you don't know what it costs per team member to do that work, which affects your profitability. Knowing your billable hours across your scope has the advantage of helping you ask better questions. It gives you an opportunity to compare and contrast different parts of the business and see potentially hidden strengths and then apply them across your business to increase efficiency and productivity.
That's exactly right. And I love what you mentioned there, because I hear this all the time of people that say, oh, well, we switched to value-based billing. So we stopped tracking time and we don't pay attention to what it costs us to do work. And then a few months later, I catch up with them like, hey, how are you doing? And they're like, somehow we're not making any money. It's like, well, geez, I wonder why that is. And this comes back to our definition of delivery margin, right? It's like the cost basis of a professional services firm is their time. That is what our business model is. Even if we don't sell time in terms of billing model, our business model is that we require skilled labor to complete deliverables for clients. And so we have to have a sense of that because it is our largest cost center. It's a great observation, Audrey.
On the subject of tracking time, when we talk about getting clarity on where the team is spending their time, a common question I get is, how do I motivate my team to track time? Have you encountered that question in your work? And what are your thoughts on that?
That's a good question. And of course, like the first thing that we can be transparent about is like nobody enjoys tracking time. Just like very few people enjoy going to the gym or brushing their teeth, but we generally will do those kinds of things because we could see how it benefits us in the end. And so I actually just did a webinar this morning with popular software product, productive.io, about this topic, and this question came up. And my answer is there are lots of tactics that you can do to try and improve timesheet compliance, but the one that we've seen work the best is just closing the loop between the time tracking data they create and the insights and conversations that it generates. And what I mean by that is, what if every month you sat down and you built an average billable rate report and sat down with your team and said, hey, let's look at all of our projects and talk about the ones that went better than we expected and talk about the ones that didn't go the way we expected. And I want to learn from all of you why, certain things went the way that they did. And now all of a sudden they're seeing like, oh, this is how that data is being used. And then the question I got was, well, what if the data is bad? I said, that's an even better reason to have the meeting. And what you want to do, and this sounds counterintuitive at first, but it'll make perfect sense, is if you know you're having timesheet compliance issues with your team, you go into that meeting and you pretend that you have no idea that the timesheet data is bad. And what will end up happening is you'll point to a project and you'll say, well, this is incredible. The client was thrilled. The work was great. And we spent half as much time on this as we thought we were going to. That's incredible. That means I can sell twice as many of these projects and you guys won't even be that busy. This is amazing. And then somebody will raise their hand and go, well, hold on, boss. Like, that's not really the case. I didn't get all my time in for that project. And then they can start to really understand like, okay, this is the impact of not being truthful. This is how decisions are getting made around this information. And the more we involve them in that process and recruit them to be a part of that conversation, it connects the dots to the story in their head behind why are we doing this in the first place. And there's nothing I've seen that's more powerful than that.
No, I think 100% when you ask someone to track their time, it feels like they're being micromanaged. And no one likes to be micromanaged at all. And, when we're asking our team to do these things that might feel like we are asking them to, be more efficient or be more productive, it can have a connotation for them. It just doesn't feel good, right? And I firmly believe that we need to be very clear and explain to our team why these things will actually work for them and not against them. I think as a leader, creating that buy-in in the front end is extremely important. And when you want to create buy-in, it's all about showcasing what's in it for them. And what you're sharing right now, Marcel, is that this is exactly the purpose of time tracking. It's not micromanagement. It's for them because it allows you to see their capacity and use their capacity efficiently, which means that, guess what? No one burns out, and which is our goal when we run our team, because let's be real, right? Our team is our greatest asset. Our team is creativity. Without this team, there is no great work. And so we want to protect them. That's this work that we're doing right now. It's helping to protect them.
That is exactly right. And you nailed, I think, the most important part, right? Which is without these feedback loops, we're making assumptions, and we resource plan based on assumptions. We sell based on assumptions. We hire based on assumptions. And if there's no feedback loop to say, hey, some of these assumptions that you're making are not even close to reality, without that feedback loop, your team is ultimately going to end up paying for that with their evenings and their weekends, and nobody wants that. And then the business is going to be cash strapped. So you're going to be forced to lay people off the second that you have a bad month, or you lose a big client, or a big retainer that you were expecting to land doesn't come through. And so you're absolutely right in that ultimately, if this is being done well, it should be protecting the team. And if that's not your intention behind time tracking, then I would encourage you as the firm owner to really evaluate that.
Thanks, Marcel. Okay. Is there anything else you would like to share about the billable rate before we move on? I know there's one more lever we haven't touched on yet. Let's get into it.
I have one last thing to say on average billable rate, which is remember that the formula is agency gross income divided by delivery hours. So a lot of times when I talk about raising average billable rate, a lot of people jump straight to pricing increases. And of course, that's one way to do it. But the other way that is equally as powerful is to find ways to decrease the amount of time it takes to do work. So if you can get more efficient, that has the same impact on your business, right? If you can do something in half the time, you can do twice as much. So don't sleep on efficiency and process improvement and technology leverage and again, getting operationally fit, because they can have the same impact without actually changing your pricing. Okay, so that's average billable rate. Now, the last one, again, a proxy for increasing revenue with the team, is what I call, for the Star Wars fans in the room, the dark saber of agency metrics, right? It has great power, but in the wrong hands, it can do great damage. It's utilization rate. We've all heard of this metric before. Some of us, we get hives when we hear the word utilization because we used to work at a big consulting firm or a big agency. And this was the whip that was cracking us all the time, was got to keep your utilization rate up, right? So it's really important to talk about this metric and how to use it properly and how to calculate it properly. So to start off, what's the formula for utilization? And let's keep in mind that the purpose of this metric is to help us understand, of all the capacity that we're purchasing in the business, how much of it is being used to earn revenue at the average billable rate that we measured earlier. And so the formula for this, before I say this, there's a project manager that's going to have an aneurysm when I say this. So bear with me here, okay? Let me get all the way through this before you turn the podcast off. We're going to take delivery hours, so all of the time that was spent on client work, again, for any cross-section of the business, any time period, any plane. And we're going to divide that by the total capacity in that cross-section. Mm-hmm. This is where people start to get tripped up. Total capacity means if we're measuring utilization for one person, it's 40 hours a week, or it's 2,080 hours a year. And so the project manager in the room that's having an aneurysm right now is saying, but Marcel, their capacity isn't 2,080 hours a year. They have vacation time. They have sick time. They have paid time off. They're not billable for 40 hours a year. So why would we make their capacity that? Well, the reason is that costs money. And if we don't include that in their capacity, then we're not reflecting the cost of that time in this formula. If you think about it, if I start removing all of that from capacity, utilization rate goes up, even if the delivery hours don't change. That's a false positive. It's the opposite of the truth. Our utilization isn't going up the more time off people take. It's going down. But why do people do that? Why do people make those adjustments to utilization? And we'll come back to billable and delivery hours because that's a whole other problem as well. But the reason is because the first mistake most people make with utilization is they put it in front of their team and they try to hold their team accountable to it. And when I say the team, I mean individual contributors, the designers and developers and project managers that are doing the client work every day. And so what happens when you do that is they start to complain, rightfully so, that, hey, I took a vacation last week and my utilization is bad. Or, hey, you asked me to work on the company website, which isn't billable, and now my utilization's bad. So why am I being punished for doing the things I'm supposed to do, taking time off and, taking holidays and working on the company website. So we start to change the definition of utilization to appease sentiment, but it's not actually making it more truthful. And the mistake was we shouldn't have put that in front of them in the first place, because our team has no control over their utilization rate. They don't get to decide how much work we sell. They also don't get to decide how many people we hire or fire, or how efficient we are at creating clarity for each individual person on the team about what they should be working on and where they should be focused. And so utilization is really meant to be a measurement of efficiency, and it should live at the management level, because that's who's accountable for utilization, not individual contributors. So that's my little soapbox rant on utilization, but I'll pause there for a moment, Audrey.
Okay, utilization rate is also known as billable hours. I can see what people might think as they hear you say that the utilization rate or billable hours should be 40 hours a week. Of course, it's not possible if you consider things like internal projects, time off, and vacation, and all those other good things. Agreed. The main point is not that every team member should be billable for 40 hours a week. The main point is that utilization rates should not be a metric at the individual contributor level.
Yep.
Instead, this is a core metric for management to make overall business decisions. And if that were the case, it would need to be based on the reality that every team member has 40 hours a week.
Right. And so immediately the thing that everybody gets insecure about is like, okay, well, if I'm setting somebody's capacity at 40 hours, then our utilization rate's going to be really low. And it's like, well, yeah, because it is. That's the truth. And so if we didn't measure it this way, we wouldn't see that. And that's a problem. Well, it might be a problem. It might not be a problem. We'll talk more about how these things work together to work to an outcome. But I'm not suggesting for a moment that we should be expecting anyone to work 40 billable hours a week. That's insane, because doing that means that we are implicitly, or we're really explicitly saying, well, I expect you to work more than what you've contractually agreed to work. That would be immoral, in my opinion. So the reality is most people, even a contributor to the team that their only job is to do client work, they might get 32, if we're really efficient, 34. If they only work on one client project and we have almost no internal meetings, maybe 36 hours in a perfect week where there's no time off, no vacations, etc. But we have to be realistic about our model. So when we think about setting targets for utilization, on a weekly basis, we're generally going to see individual contributors land between 75 and 90%. And on an annual basis, we're going to generally take 10 to 20% off of that target to account for holidays, paid time off, et cetera. And so you could just do the math on this in a spreadsheet. It's really not very complicated. And the objective is to get a team composition, all things being equal, that 50% or more of all of the time on the team, including people that do zero billable work for clients, can be utilized for doing work for clients, right? So the target, people are like, oh my God, 50%, that's not very high. It's like, yeah, it's not, because that's the reality is there's lots of other things that we need to do that are not client work and somebody's got to do them. And we all have to have a life outside of work. But we need to be real about that, because then the question is, okay, well, what do we need to charge and how efficient do we need to be on our average billable rate to still make enough money to make this business profitable? And it's not being objective about these things that I think leads people to measure these in a way that's a little bit more convenient for their sentiment, but ends up costing them 15% on their bottom line at the end of the year.
Yeah, what's really interesting in what you're bringing forward is a common misconception about using utilization rates. You're emphasizing the importance of being real about those numbers so leaders can make more sustainable and beneficial decisions for both the employees and the business. And being real about those numbers doesn't equal asking your employees to have 40 hours a week billable.
That's right.
It's intended to give you more clarity so you can, again, ask better questions of your business and work with your financial consultant or CFO to make better decisions.
And this is where I think let's start to zoom out and connect the dots on this framework, because now if we want to do some math on, for example, how much revenue am I capable of selling within the expectations that I have for my team without burning anybody out next year? Well, if we want to do the math on that, it's actually really simple using these operational metrics. I'll draw on an example. Let's imagine we have a team of 5 people and their total capacity is roughly 10,000 hours, about 2,000 hours per person in a year. If we had a 50% utilization rate, that means we expect about 5,000 of those 10,000 hours to be used for client stuff. If we had an average billable rate of $100 per hour, that's a $500,000 revenue capacity for that team. Now, if we increase that utilization rate to 60% and we kept the average billable rate the same, now we could do about $600,000 of work. And if we kept the utilization rate at 60% and we increased our average billable rate just up to 125, now that same team can do $750,000 in agency gross income. And so if we imagine that the payroll for that team of 5 people was $300,000 and we spent another $150 on overhead, in the first example, we had a 10% profit margin, $50,000 of profit on $500,000. And we had a delivery margin of 40%. In the second example, we went from $500K to $600K in revenue, but none of our costs have changed, right? We just got more efficient. So we now have 50% delivery margin, and we did 25% net profit, right? $150,000 on $600K. And in the third example, we go to a 60% delivery margin and a 40% EBITDA, right? $300,000 on $750K. That's the incredible impact of, instead of focusing on cutting little admin costs, looking at the efficiency of the business and focusing there. And these little tweaks in these metrics that don't seem that consequential, when you really zoom out and see the financial impact, that's how the dots are connected. And what I want to really double click on here is that there's an infinite combination, as you can see, of utilization rates and average billable rates that get you to the same outcome. You could say, hey, you know what? I want to do a 4-day work week. I want to give people 6 weeks of vacation each year. I want to give people 20% of their time to work on personal projects. That's fine. You could have a 20% utilization rate and still be profitable. You just have to pay for it somehow. And usually that means you have to have a really high average billable rate, get really good at charging premium rates, being super efficient, having a great process. But you can earn the right to design your business however you want within this framework. So I just want to make that clear.
If I were to summarize that, I would say knowing your numbers allows you more flexibility to design your business how you want to and be profitable, because in theory, you can make infinite adjustments or look for opportunities in your metrics. Marcel, in the time that we've discussed setting up profit and loss statements, delivery margins, time tracking, utilization rates, and so much more. I might be asking the impossible, but how would you summarize it all up in 1 or 2 sentences?
Well, if you want to have a profitable agency, spend less than 50 cents to earn $1. And if you can do that consistently, everything will get easier after that. That's it.
Boom. There we have it. Thank you, Marcel, for hanging out with us at the Small But Mighty Agency Podcast.
Thank you, Audrey.
Hey there. Thanks for hanging out with me at the Small But Mighty Agency Podcast. If you enjoyed this episode, it would mean the world to me if you hit the follow or subscribe button in your podcast app and share it with a friend. I'll see you in the next one.